With global economic instability, interest in gold as a safe asset has been rapidly growing.
Are you a little worried about the parabolic move that is coming into gold prices?
Gold has fascinated humanity for centuries, from ancient temples to modern vaults. But today, something unusual is happening. Gold is suddenly on the move again. In this video, let's explore what's behind this explosive rally and why gold has remained one of the most important commodities since the dawn of civilization.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
Once upon a time, gold was money, quite literally. Across the world, many countries had their currencies linked to gold. Even the mighty US dollar was backed by it. But all of that changed in 1971, when President Richard Nixon removed the gold standard, a moment now known as the Nixon shock. Since then, gold has been freely traded in global markets. And just for perspective, gold price increased from $37 in 1971 to nearly $3,300 per ounce. That's nearly a 90 times jump in less than a century. But here's the thing. This rise has played out over a very long time scale, about 55 years. If we zoom in, we see something different. Gold has had major ups and downs, sharp rallies, and deep corrections. And interestingly, most of those swings have coincided with periods of uncertainty, recessions, crises, wars, or inflation scares. In many ways, gold reacts like a sensor to fear in the system.
Massive shortages ensued, and gasoline prices increased as much as 40%.
In 1973, crude oil came as the problem. OPEC cut oil supply, leading to increase in prices, and inflation went out of control across all the developed countries. To fight inflation, people wanted to buy gold, but it was not allowed back then in USA since 1933. Further, in 1974, after 41 years, the US finally allowed private citizens to buy gold, thus creating a massive rush to own it. People began losing trust in their currency, which was losing value fast. Gold, on the other hand, held its ground. It felt like real money. Why? Because when inflation rises, the purchasing power of money drops. $1 now buys you less. The dollar's value is falling. So people looked for an alternate store of value, and that was gold. So gold didn't just rise, it became a protest against inflation and a failing dollar. After the inflation spike, by 1975 to 76, things began to cool down. Inflation dropped significantly, and with it, gold. By the end of 1976, gold prices had fallen nearly 50%, dropping from around $200 to $100 per ounce. This is a classic market cycle. When times were bad, people rushed into gold. But by the time everyone had bought in, it was already too late. When the crowd finally joins the trend, it often marks the peak. Everyone had gold. And then came the fall. The lesson? Markets move before the masses do. And gold is no exception.
Students continue to hold more than 50 hostages at the American Embassy in Tehran this morning.
Even though most analysts knew there were thousands of Soviet troops in Afghanistan.
In the 1980s, gold saw an incredible rise, nearly 6 times its price in just 4 years. So what drove this? It wasn't just speculation. The 1980s oil flood was a key factor. After the energy crisis of the 70s, oil production skyrocketed, flooding the market with excess crude. But it wasn't only oil. Geopolitical tension played a massive role. The Iran hostage crisis and Russia's invasion of Afghanistan in 1979 created global instability. People rushed to gold as a safe haven against the chaos.
I have come to speak to you tonight about our economic recovery program and why I believe it's essential that the Congress approve this package.
From the Berlin Wall specifically, take a look at them. They've been there since last night. They are here in the thousands, they are here in the tens of thousands.
After all the volatility of the 70s and 80s, gold seemed to lose its shine and went sideways to downside for next 23 years. This was due to the stock market booming, technology advancing, and the world moving forward. In 1988, Reganomics shifted U.S. economic policies towards deregulation and tax cuts to tackle stagflation. The fall of the Berlin Wall in 1989 and the collapse of the Soviet Union in 1991 reduced geopolitical tensions. With the U.S. dollar strengthening, people trusted the currency more than gold. Throughout the 1990s, the tech boom led by companies like Microsoft, Apple, and Amazon captured investor attention. As internet stocks soared, gold became less attractive. Gold lost its shine by nearly 50%.
It's described as nothing short of breathtaking, a points drop never before seen on the US markets.
In the 2000s, the dot-com bubble burst and tech stocks plummeted by nearly 50%. Investors, burned by massive losses, turned to gold as a safer option. The stock market dropped 50% in 2000. Over the next 11 years, gold surged by 7 times. As investors sought a safe haven from the volatility in the stock market,
down by 5%. We're down over 16%. Dow at the same time has fallen about 18%.
From 2008 to 2011, during the global financial crisis, gold once again acted as a safe haven as stock markets collapsed. Gold prices surged, peaking in 2011 and reaching levels not seen since the 1980s. This was driven by the collapse of the U.S. housing market, which led to the crisis. But after reaching its peak in 2011, gold dropped by 44% as stock markets began to recover and interest rates normalized.
Serious new virus.
Coronavirus.
Ukrainian emergency officials say Russia has carried out a large-scale attack on the capital, Kyiv.
Recently, gold experienced a significant surge, nearly doubling in value from $1,617 to $3,297. This was driven by several factors, starting from COVID virus outbreak, then Russia-Ukraine conflict, which led to inflation spiked globally, and central banks began accumulating more gold. Moreover, in 2023, China made large purchases, further boosting demand. Further, in 2024, geopolitical tensions like the Palestine-Israel war and rising national debt, especially in the U.S., fueled concerns. Now, U.S. debt to GDP ratio has reached levels higher than the 1930s Great Depression, further highlighting gold's role as a safe haven.
I think gold should be a part of everybody's portfolio to some.
Different analysts offer unique views on gold and its role in the global economy. Ray Dalio, founder of Bridgewater Associates, believes gold works as a hedge against inflation. He also says that gold protects against currency devaluation. Peter Schiff, CEO of Euro-Pacific Capital, also sees gold as a hedge against inflation and the US dollar, citing its limited supply. James Rickards, author of Currency Wars, sees gold as a strategic asset in times of geopolitical tension and financial instability. Lynn Alden, an investment strategist, suggests that gold performs well when traditional investments fall short. Raghuram Rajan, former Reserve Bank of India governor, highlights gold's importance in emerging markets, where it acts as a trusted asset during times of currency volatility. So right now, I'm remembering a line from the book Deemer on Technical Analysis. He writes that when a person buys gold, are they really buying gold, or are they simply betting against the currency? When I read this line, it really stuck with me, and it got me thinking, maybe gold isn't the safe haven we always think it is. In reality, we often buy gold when we're essentially trying to short currencies. So the next time we consider gold as a safe investment, we have to ask ourselves, are we investing in gold, or are we betting on the failure of fiat currencies? That's a thought to reflect on for the future. Please don't forget to subscribe, like, and share your thoughts in the comments below. Thanks for watching.